What happens to real estate values during a recession? This question has come up a lot recently. First, we have to properly define what it means to be in a recession. A recession is generally defined as a period of time when an economy has 2 consecutive quarters of negative GDP growth. One of the most reliable indicators of an impending recession is the inversion of the yield curve. The US 10-year and 2-year Treasury spread has been a reliable recession indicator since the 1960s. Since then, there's been a total of 9 recessions, with the yield curve inverting every time and a recession taking place 6 to 24 months after the inversion. The 10-year note typically yields more than the 2-year note because it has a longer duration. But when the yield curve inverts, you get a smaller return for a longer investment period. That's like you going to the bank and getting a 2% return on a 10-year CD and a 2.1% return on a 2-year CD. During normal times, there's about 100 to 150 point basis spread between the 2-year and the 10-year treasuries. At the time of this video, we're only 5 basis points away from the yield curve inverting again. With the yield curve being so tight, it could be just days before we see an inversion. But what happens to real estate prices during a recession? Well, if you take a look at the chart, real estate has only declined once over the past 9 recessions, and that was in 2008 when the recession was caused by speculation, overbuilding, and bad loan products. The gray bars in the chart represent the 9 recent recessions, and the white line represents home values. As you can see, real estate has actually increased in value during and following many recessions. Looking back on history, real estate has been a safe haven in times of recession, unlike other investment classes such as the stock market, which it isn't uncommon to see a 10 to 30% decline during a recession. So before you start panicking, know that real estate is one of the safest places to have your money during a recession.